topic which is very dear to my heart because I've been associated with corporate restructuring, tax issues, regulatory issues for last 10 plus years. And the beauty of this topic is that the more you get deeper into it, the more you come to know that you don't know much. And the laws, the way they are in India, they are evolving very periodically. So one case law may say something, immediately next case law seems to challenge the earlier case law. So really it keeps on evolving. And truly English is a funny language in that sense because interpretations could be varied on any laws. So that keeps us in business. Am I right? So the more the confusion, the more we are in business. So at the outset, I would like to thank Sujal Bhai and team for giving me this opportunity and also the Chamber of Tax Consultants to present before you wonderful audience who are fellow professionals, experienced, and I'm sure we'll have a very fruitful session. And the topic I've chosen for today is corporate restructuring, what are direct tax issues and what are recent developments in domestic and international front. And in terms of content, I have broken down the topic into various facets of corporate restructuring, which is mergers. The second topic will be on demergers, slum sale, slum exchange. What are the tax issues on corporate restructuring which have come up recently? Certain trends in international taxation which have a bearing on India as well. And what are the upcoming challenges? What are the changes we anticipate in the law going forward? How is it going to impact corporate restructuring? So the attempt here is to pick out some technical issues which we face on a day-to-day basis and the practical challenges which we face in our day-to-day business, and to give you a flavor on how the law has evolved around those challenges. The first topic is on mergers, and of late, the most important issue which has cropped up in the scenario where you're merging two entities is the whole issue around creating of goodwill and whether goodwill is a tax depreciable asset or no. So the legal trend or the case law trend on this has been that earlier there were defined decisions on whether goodwill is a tax depreciable asset or no. There were case laws both ways. Some said that it is an intangible right of the commercial nature or similar right as highlighted in section 32. Some case laws say no, it cannot be, goodwill can't turn bad way. So how can we take depreciation on it? And just to quote a few case laws on this front, there is a Mumbai ITAT judgment in the case of KC International where it's been ruled that brands are a depreciable asset, and even if you record in the merger the brands as goodwill, the nomenclature is not important. What is important is what is actually in nature. Does it take the color of assets which are part of section 32 intangible asset definition? And if it fits within that, and if you can justify it, then even if you have the nomenclature as goodwill, you can claim depreciation. On a similar footing, Mumbai ITAT in the case of Kota Forex, also in the context of business acquisition, has said that brand name trademarks, even though mentioned as goodwill in the accounting, can be claimed as depreciation as long as you are fitting within the definition of intangible as per section 32. On the flip side, there are against decisions also in the case of RG Keswani, again Mumbai ITAT judgment, and also in the case of Vodka packaging, which is a Panji ITAT decision. So there were a plethora of case law on this front in the past. The debate was whether goodwill is a depreciable asset, not a depreciable asset. And 2-3 years ago, there was Supreme Court decisions in the case of Smiths, which ruled that goodwill is indeed a depreciable asset. And the facts of the case were that in the course of accounting, by merger in the nature of purchase, in the particular transaction where one company merged with the other, goodwill was created. All the Supreme Court ruled on this particular case law was that goodwill is tax depreciable. But the second question remained unanswered. The second question which remained unanswered is, how much is the quantum of goodwill which will be available to the merged entity because of this treatment? Will you get the entire goodwill as depreciation, or will there be restrictions? So, what the Supreme Court didn't go into in detail is these explanations to section 43. The explanation 7 to section 43(1), which speaks about the actual cost and which mentions that where the scheme of amalgamation, any capital asset is transferred by the amalgamating company to the amalgamated company, and the amalgamated company is an Indian company, the actual cost of the transferred capital asset to the amalgamated company shall be taken to be the same as it would have been if the amalgamating company had continued to hold the capital asset for the purpose of its own business. So the distinction we are trying to draw out here is there could be situations where goodwill is already a part of the assets in the amalgamating company's books. There could be a situation where in the course of accounting in merger and the nature of project as per account sheet 14, you record goodwill. So that goodwill which you record is a consequence of the merger. And the goodwill in the first case, which is already a part of the merged entity, is a part of that entity and which gets amalgamated into amalgamated company. Now the idea behind restricting this actual cost is obvious reason is that merger anyway is a tax neutral transaction. So there is no taxation for the merging entity, there is no taxation for the shareholders. The period of holding gets grandfather, the cost gets grandfather and the shareholders. So by giving them extra depreciation on whatever asset base is there already in the company, over and above that, it will be a double benefit. So, is the intent of law to restrict goodwill only to a situation, depreciation only to a situation where goodwill is already part of merged entity, or is it extendable to also a situation where goodwill was created as part of merger? So that is a question of debate. Similarly, you look at explanation 2 of section 43(6), where it's defined the written down value of block of assets. Wherein in previous year any block of assets is transferred by the amalgamated company to the amalgamated company in the scheme of amalgamation, and the amalgamated company is an Indian company, then notwithstanding anything contained in clause 1, the actual cost of block of assets in the case of transferring company or the amalgamated company, as the case may be, shall be the WDV of block of assets as in the case of transfer company. Or again, it restricts only to WDV of the asset in the amalgamated company. So both these sections are on a similar line. If you extend further, if you look at section 35 of the Income Tax Act, there too in a case of succession or amalgamation, the depreciation is split on the basis of number of days to the transfer company and then to the successor company. And there too is restricted only to the existing WDV. So you can't get cost step up in respect of that depreciation. So if you read all these three together, the question which crops up is, in a situation like Smith's, okay, the Supreme Court ruled that goodwill is a depreciation asset. What is the quantum of depreciation? Can I get it on that goodwill which I paid? Fortunately, there have been case laws post Smith security which further amplify on what could be the possible view on this problem. And there is one ITAT judgment of Bangalore in the case of United Breweries, where it has been ruled recently that in a situation where goodwill is already existing on the books of the amalgamated company, these particular explanations and sections which we spoke about, depreciation will be restricted only to that goodwill and not to a situation where as a consequence of merger you are creating a new goodwill. So if I take you through these case laws, what had happened was there were 3 subsidiaries in United Breweries which were merged into the old co, and the goodwill has been recorded as a consequence of excess of consideration over net sales taken over in the merger. and one of the subsidiaries had a goodwill in its books of 7 crores. Upon giving effect to the scheme, amalgamated company recorded goodwill of 63 crores. So the question before Bangalore ITAC was whether we should give depreciation on 63 crores or whether it should restrict it only to 7 crores. And the view is that it has to be restricted only to 7 crores. So again, the law is evolving. I'm sure assessment is going to appeal against this. So we have to wait and watch how this pans out going forward. Whether really we can take the advantage of goodwill and the control recognition can be on the goodwill which arose as a result of merger going forward.
Vikram, small second point. Can the amalgamating company basically create a goodwill, self-generated goodwill and record it in its books prior to the amalgamation? And then maybe when the amalgamation takes place, it's already there, the value sits there, and it can be taken.
So you will do pooling of interest?
I may do pooling of interest, I may do purchase also.
No, but can you do self-generated goodwill? You can't account for self-generated goodwill. It has to be acquired goodwill.
I may not be able to claim depreciation on that. I can still record it and basically increase my reserves to that extent.
You can do that, but accounting doesn't allow you to do accounting of self-generated intangible. I think there is a challenge. Anyone in the audience, can you really do accounting of self-generated asset? You can't. So, yeah, so you are acquired goodwill you can do. Any questions on this? So what I can do is every topic, I can wait for some time and you can answer any questions you have.
So we technically right now do not have a clarity on the quantum of goodwill on amalgamation that can be. But Swift solely answers that goodwill can be there. That's it.
Yeah, that's right. Now see, again when we flip to this, people may say that as we discussed, you cannot record intangible, self-generated intangible.
I've always had and said
it's always zero. So revenue can flip on it and say that was it was always zero. So you still apply the explanation, still apply the 32 5 and you will not give any depreciation. So that could also be one of the flip side of this. And now the law is changing. So obviously this will earlier yes 14 was applicable. Now in a situation where there is group merger, holding subsidiary merger, now you can't create goodwill under IAS. So reserves can't be created, goodwill cannot be created. So it may die down over time. Really. It's only in a situation where there is a third party merger, you can create goodwill going forward. That would be relevant in that context. Anyone else?
So, do you think this stand of ITAC would sustain in case of United Privilege?
Based on the interpretation of the wording, yes, it should sustain. But the more enlightened the review gets about this, so the fact that you can't record an intangible, self-generated intangible, when that comes to light to them during the assessments of other cases, then obviously they will say that no, nothing going, we cannot get this. So it will be restricted only to that zero. It won't be, you won't get goodwill on the consequential accounting model. So this is open.
Is software an intangible asset?
Yes.
I can still recognize that in my books, right?
Yes, so what you can do is goodwill. You can break it up into intangibles, which fits within the definition of goodwill. Justify the valuation and you just put that as a brand, whichever fits in. Balance is goodwill. Should I proceed? Okay, this is demergers. So, just to give you a perspective, demerger came in 2000, the provisions. And this particular case I am talking about pertains to before the demerger provisions came in place. And general school of thought based on a decision was, there was an ITAC decision in this particular case, that even if you do non-taxable demergers, it should be exempt from tax. What is the flip side of doing non-taxable demerger? So, non-taxable demerger can happen in the following cases. One, where you don't give proportionate shares to the shareholders. Second case could be you record in the books of the resulting company at fair value. Third case could be you fail the undertaking test. These are various combinations of which you can't meet the 298 conditions of demerger. And this particular ITAT decision seemed to give some sort of a strong backup for taking a stand that you can do non-taxable demerger and get away with it. So you don't really, there's no tax eventuality. All that changed when the High Court overturned the ITAT decision. So now an entire new issue has risen. In light of today's legislation, the way it is, if you want to do a non-taxable demerger, will there be a tax incidence? If at all there is a tax incidence, for whom is the tax incidence? Is it the demerged company? Is it the resulting company? Or is it the shareholder? So we'll get into that. So I'll just tell you the facts of the case. So we have a Holdco private limited company which is holding 100% in OPCO 1. And OPCO 1 has two divisions, Division A and B. Division B got hived off into OPCO 2. Okay? And it was a scheme of arrangement. Mind you, this was before the demerger provisions. And what the scheme of arrangement stated was that this Division B is hived off to OPCO 2 at say X value, 50 crores. That's the consideration. And in discharge of the consideration, part consideration will be paid to OPCO 1 in cash and shares, and part consideration will be paid to Holdco private limited, the shareholder, in shares. So the consideration was around 50 crores, and the split was 66-34. So 66% of 50 crore went to OPCO 1. The company itself is hived off the business, and 24% of it went to the shareholder, which is the Holdco private limited. So the question which came up was, is this a taxable event for the OPCO 1? And the ITAT ruled that for the OPCO 1, there is no taxation for the 34% which went to the shareholder because the consideration has not reached OPCO 1. So when there is no consideration, which is the receiver of OPCO 1, the competition mechanism fails and there is no tax for the 24%. And this ITAT judgment was in the case of Sullivan International. But just recently the Delhi High Court has overturned it. And what it's ruled is, in this decision is that you have mentioned the scheme that the transfer of the division is for X consideration. And in discharge of that consideration, you are being paid part and part of it is going up. So it's a case of application of income more than diversion of income by overriding title. So just because in the scheme you have made a fancy wording and said that part of it will go to the shareholder, doesn't mean that it's just a diversion of income. It's an application of income. So this actually opens up controversy in case of all non-taxable demergers which we are talking about. And going forward, of course this is still being debated. The assessee has gone to Supreme Court, and we have to see how this pans out at the Supreme Court level. But the way this has been finally judged by the High Court is going to have some sort of influence on how we structure demergers. So we have to be very careful that we comply with the 298 conditions to the T, be it the shareholders getting shares in the company proportionately, be it most importantly undertaking test. You can't just have a camouflage sort of assets and liabilities and move without it being passing the undertaking test. And in the accounting for that matter, in the accounting will have to be followed to the T, because this might be a door open for litigation going forward. Now, I was just trying to reflect and analyze what will be caught under the non-taxable neutral demerger? Who will be taxed? So let's say a company A is there and it demerges a division to company B and shares are issued to the shareholders. And for some reason the demerger conditions are not fulfilled. Now when it demerges the business into company B, shares are issued to the shareholders, demerged company is getting nothing. Again, consideration not received for that. So really can you cash in that? Answer is no. Second is shareholders retain shares in a demerged company, it gets more shares in the resulting company. Again, the reason why they gain shares in the resulting company is because of the loss of value in the demerged company. The business has split. So is it a consideration? Is it an exchange? Answer is no. The only areas where the problems could arise is if there are losses in the demerged entity, which you want to move in a demerger into the resulting company. And second is your cost base. So if you are a tax neutral demerger, then there is a particular formula for the cost base for the shares held by the shareholders in the demerged entity to move into the resulting company. So those two things can be disturbed. And one very theoretical risk is if you look at the wordings of dividend as per section 222, there is an exception carved out in a situation where the resulting company issues shares as a consideration for demerger to shareholder or demerged entity. Now that demerger has to be strictly in accordance with 219A. So if you don't comply with it, there is a possibility that if there are accumulated reserves or profits in the resulting company, there could be issue of dividend tax also on that part. So that is something which is again an open area. Of course, this is not discussed in Salora. And the way you can distinguish Salora from a non-tax neutral demerger is in Salora, they mentioned for some reason that the consideration for transfer of the undertaking is X. That's what got them in trouble. And in discharge of that consideration, shares are being issued to the operating company 1 and the shareholder company 1. So that way you can distinguish it. But this again is a matter which time will tell how it will evolve. Especially in light of the fact that even when you actually implement the process, the regional director is also practically looking at it based on seeing that all the conditions are met on. So that is something is a wait and watch going forward. Any questions? Okay, one more thing I forgot to mention is there is section 50D. So in section 50D issue, even in section 50D, it says that any income accruing or arising on account of any transaction, if you cannot work out the consideration, you can't work out the consideration to take fair market value. But there it presupposes that the consideration has to flow on the transaction. So again, you really can't apply 50D because in a situation of demerger, there is no consideration flowing to the demerger entity. So there also you are safe in that sense. Any thoughts? We can debate. I would love to know something different